China is on the brink of economic collapse, and while some believe this is a unique situation, we've seen this story before.
The stock market is now down 21%. What in the world is happening on Wall Street?
It was the worst day on Wall Street since the crash of 1987.
Two questions were posed in 2008. One, how could this ever happen? And two, how can we make sure this never happens again?
Well, there are fresh signs of trouble for China's embattled property sector. Not only are home buyers refusing to pay their mortgages, developers' bonds are plummeting.
The United States implemented many regulations following the 2008 housing crisis, but China plays by their own set of rules. And now, it appears that a little history lesson might have saved them a major headache. So back to question number one. How did this happen? In China, home values have increased sixfold over the last 15 years as a growing middle class rushed to real estate as one of the few secure assets available. The boom encouraged speculative home buying as new homes were pre-sold by real estate developers who increasingly looked to foreign investors for funding. Chinese authorities feared the possibility of a housing bubble and took steps to prevent the problems that overpriced housing may bring to the country. However, these attempts to fix the market had an overcorrection effect and in turn lowered cash flows to a standstill. As COVID-19 containment efforts intensified, a dangerously steep sales decline had begun. In 1998, China officially allowed for foreign direct investment into their previously restricted housing market. At this time, only a third of its people lived in towns and cities. Now, over 2/3 of Chinese citizens live within towns and city lines, adding 480 million more people to the metropolitan population. In order to keep up, the real estate business grew quickly. Based on price-to-income ratios, boom towns like Shenzhen became less accessible than the world's most expensive cities like London or New York. To contribute to the expansion of the real estate market, the CCP had put in place extremely high annual targets for economic growth.
A sign of post-pandemic recovery in China. It has set a new economic growth target of over 6% for the year after admitting it for the first time in decades last year.
These goals were often only met in part because of the encouragement of additional development by local and regional authorities, who derived a significant portion of their income from sales of public land. As builders raced to meet demand, debt accumulated. US dollar offshore bonds saw a sharp increase in annual sales from $675 million in 2009 to $64.7 billion in 2020, which increased the burden of interest payments that needed to be paid back to foreign investors. Developers either need to pay back their bonds and risk economic collapse or lose the faith of foreign investors forever.
Credit risk is flashing. Where are we between amber and red in China? How do I differentiate the credit risk?
The CCP is trying to salvage this mess. It has been attempting to defuse the debt bomb for years out of concern that an explosion could trigger a catastrophic financial crisis. The CCP started to restrict new financing for real estate developers in the middle of 2020 and ordered banks to cut down mortgage lending. This introduction of new borrowing criteria for developers changed the game. They called this policy 3 red lines.
There are these 3 red lines. The government developed this system to curb borrowing. First, to ensure a liability to asset ratio of less than 70%. Then, the next line, a net gearing ratio of less than 100%. And the third line, cash to short-term debt ratio of at least 1. If you cross all 3 of these lines, which Evergrande does, this will restrict you from borrowing more money.
Because they set limits for a developer's liabilities, debt, and cash holdings, and sought to discourage careless borrowing. Depending on how many criteria were met, the amount of borrowing each year would be limited. Cash flows were slowly coming to a halt, and developers were left scrambling. What happened to the developers? Those who didn't have enough cash on hand to pay their debts were in a difficult situation. After the crackdown started, at least 18 offshore bonds went into default. China Evergrande Group, formerly the biggest developer in the nation, received its first defaulter designation in December after failing to make payments on a number of debts.
The stakes are too high for Beijing to let Evergrande fail. Nearly 3/4 of household wealth in China are estimated to be tied up in property.
For the company to avoid its total collapse, it created the Risk Management Committee, run by provisional officials. Sunok China Holdings Limited and Kaiser Group Holdings Limited were soon followed by other organizations. Fears of further spread have rippled through the sector and the larger economy, stifling domestic growth, eroding consumer confidence, and upsetting international markets that had long thought China's real estate titans would be supported by the government. Where does this leave the industry? In a serious funk. The combined sales of the top 100 developers halved over the last 12 months. At the end of March, the growth of property loans dropped to its lowest level in more than 20 years. 2021 had the largest decline in construction in 6 years, a 14% drop from the previous year. When non-residential construction, building materials, and related activity like real estate services are taken into consideration, China's real estate sector accounts for approximately a quarter of the country's gross domestic product. So when it gets hit, China feels it. Just as the market was beginning to show signs of stabilization, the mortgage protests began. Developers in China had cash flow issues and abandoned millions of square feet of unfinished flats to sit idle. In mid-July, economists at Nomura International HK projected that from 2013 to 2020, only around 60% of homes pre-sold by Chinese developers had been inhabited. Millions more homebuyers who put down money in advance could be in limbo if a full-blown catastrophe occurs. Certain bias safeguards that are frequently utilized abroad, like escrow accounts and installment payments, tend to be weak. For the first time in 6 years, home prices started to decline in September of last year. Fire sales would further devastate the market, pressuring other developers and having an impact on suppliers and businesses in adjacent industries. This historic bond sell-off would start with lower-rated real estate companies and move up through stronger competitors and banks to the much bigger domestic credit market, creating a global investor panic sell-off. The protests. At one point in mid-July, there were over 300 housing projects and 90 localities affected by the wildcat boycotts, which put loans worth up to 2 trillion won, $295 billion, in jeopardy. Between 1.8% and 6.5% of all mortgages in China could be exposed, according to Bloomberg Intelligence, all while the ruling Communist Party seeks stability before the crucial party congress later this year, where Xi Jinping is anticipated to be elected for a third term. These boycotts are both politically sensitive and pose a risk to the broader housing market by keeping potential buyers on the sidelines. The government has further plans to fix the crisis.
It is important for us to use both the invisible hand and the visible hand to form synergy between market forces and government function and strive to achieve both efficiency and fairness.
In response to the mortgage boycotts, authorities have promised greater regulation of pre-sales, the popular way to purchase a home that requires buyers to begin repaying their loans, even on projects that are still under construction. For some home buyers, a payment grace period was reportedly being considered. The government is offering 200 billion won, about $29.3 billion, in special loans to ensure that stalled housing projects are delivered to buyers, which is Beijing's largest financial commitment to date. A few other rules have changed by the administration in an effort to calm the situation. For instance, the central bank increased its support for a number of struggling developers, and banks were given instructions to ensure growth in some regions for both household mortgages and loans to developers. The benchmark interest rates of China lenders have decreased. The CCP is focusing on preventing a Lehman moment, when the collapse of the US bank in 2008 sent shockwaves across the world's markets. So what do you think? Are people overreacting? Or is this laying the groundwork for a major financial crisis? Let us know in the comments down below, and make sure to subscribe so you can stay in the loop.